Welcome to How to Find Undervalued Stocks, a step-by-step guide. Did you know that around 90% of individual investors underperform the market? Shocking, right? But here's the good news. You don't have to be part of that statistic. Imagine turning a $10,000 investment into $100,000. It's possible with the right strategies. Many legendary investors, like Warren Buffett, have done it by focusing on undervalued stocks. They find hidden gems that others overlook. In this video, we'll uncover the secrets to finding these undervalued stocks. You'll learn about unconventional methods that go beyond typical financial analysis. We'll explore how to understand market sentiment, dive deep into financials, and identify catalysts that can boost a stock's price. Did you know that companies with high insider buying often outperform the market? Or that spin-offs can outshine their parent companies? These are just a few of the insights we'll cover. By the end of this video, you'll have a toolkit full of strategies to find and invest in undervalued stocks. Stay tuned to discover how to hunt for hidden gems, master market sentiment, dive into financial forensics, spot powerful catalysts, and leverage contrarian strategies. Plus, we'll wrap it all up with a blueprint for long-term success. Ready to transform your investing game? Let's dive in. Chapter 1. The Hidden Gems Hunt. When it comes to finding undervalued stocks, most investors stick to the basics. But what if I told you there's more to the hunt? Think of it like searching for treasure where no one else is looking. For example, insider buying is a great indicator. When company insiders are buying their own stock, it's often a sign they believe the price will go up. Using stock screeners can also help you find these hidden gems. Sites like Finviz and GuruFocus offer advanced filters. You can look for companies with low P/E ratios, high dividend yields, or strong cash flow. These criteria can point you towards undervalued stocks that others might miss. Another trick is to look at special situations. This includes things like spin-offs, restructurings, or companies emerging from bankruptcy. These events can create opportunities for savvy investors. For example, a study from Credit Suisse found that spin-offs often outperform the market. Let's talk about overlooked sectors. Sometimes entire industries fall out of favor. During the 2008 financial crisis, for instance, the banking sector was hit hard. But those who invested in strong banks like JP Chase made significant gains as the sector recovered. You can also dig into smaller companies. Micro-cap stocks are often ignored by large institutional investors. Yet, they can offer significant upside. A report by Ibbotson Associates found that small-cap stocks have historically outperformed large-cap stocks over the long term. Don't forget about earnings calls. Listening to or reading transcripts of earnings calls can give you insights into a company's future prospects. Look for companies that have strong guidance but are currently undervalued by the market. Another method is to follow the money. Check out where big investors like Warren Buffett and Seth Klarman are putting their money. These investors have a track record of finding undervalued stocks, and their moves can provide valuable clues. Lastly, always keep an eye on corporate buybacks. When a company buys back its own stock, it often means the management believes the stock is undervalued. This can be a strong signal for you to consider investing. By using these unconventional methods, you can increase your chances of finding truly undervalued stocks. Remember, the key is to look where others aren't. Happy hunting! Chapter 2. The Art of Market Sentiment. Understanding market sentiment is crucial for finding undervalued stocks. Market sentiment refers to the overall attitude of investors towards a particular stock or market. When the sentiment is overly negative, it can create buying opportunities. One way to gauge sentiment is by following the news. Negative headlines can drive a stock's price down, even if the company's fundamentals are strong. For example, a scandal or a lawsuit can create temporary dips. Savvy investors can capitalize on these dips. Social media is another powerful tool. Platforms like Twitter and Reddit can provide real-time sentiment analysis. For instance, the GameStop saga in 2021 showed how retail investors can influence stock prices through social media. Another useful indicator is the VIX, often referred to as the fear index. When the VIX is high, it indicates that investors are scared. High fear can lead to overselling, creating opportunities for value investors. Let's not forget about short interest. A high short interest can indicate that many investors are betting against a stock. But if the company performs better than expected, a short squeeze can drive the price up quickly. Sentiment surveys can also be insightful. Surveys like the AAII Investor Sentiment Survey measure the mood of individual investors. Extreme bearishness in these surveys often precedes market rallies. Consider the put-call ratio as well. A high put-call ratio indicates that more investors are buying puts than calls, suggesting bearish sentiment. Contrarian investors can use this as a signal to buy. Earnings season can also be a goldmine for sentiment analysis. Stocks often react strongly to earnings reports. If a company's stock drops despite strong earnings, it might be an overreaction from the market. Remember the dot-com bubble? During that time, sentiment was extremely bullish. Investors were buying tech stocks at any price. But those who remained cautious and invested in undervalued companies like Apple and Microsoft reaped huge rewards later. Quotes from investing legends can also be a source of wisdom. Warren Buffett once said, "Be fearful when others are greedy and greedy when others are fearful." This quote encapsulates the essence of contrarian investing based on sentiment. Chapter 3. Deep dive into financial forensics. In value investing, understanding a company's financials is key. But it's more than just looking at the numbers. It's about digging deeper to uncover the true health of a business. This chapter will show you how to become a financial detective. Start with the balance sheet. Look for companies with strong assets and manageable liabilities. A high level of debt can be a red flag. Companies with low debt are often better positioned to weather economic downturns. Cash flow is another critical metric. Companies with positive cash flow are generating more money than they are spending. This can be a sign of financial health. According to a study by McKinsey, companies with strong cash flow tend to outperform their peers. Profit margins can tell you a lot about a company's efficiency. High profit margins often indicate a competitive advantage. Warren Buffett once said, "The business schools reward difficult complex behavior more than simple behavior, but simple behavior is more effective." In other words, focus on simple, effective metrics like profit margins. Return on equity, ROE, measures how well a company generates profit from shareholders' equity. A high ROE can be a sign of a strong business. But be cautious of companies with inflated ROE due to high debt. Look at earnings growth over time. Consistent earnings growth is a good indicator of a company's potential. A study by Harvard Business Review found that companies with steady earnings growth tend to have higher stock returns. Another tool is the price-to-earnings (P/E) ratio. A low P/E ratio can indicate that a stock is undervalued. But it's important to compare the P/E ratio to industry peers. A low P/E in one sector might not be the same in another. Don't overlook dividends. Companies that pay regular dividends are often financially stable. Dividends can also provide a steady income stream. According to research by Ned Davis, dividend-paying stocks have outperformed non-dividend payers over the long term. Investigate management quality. A strong, experienced management team can make a big difference. Look at their track record and how they've navigated past challenges. Peter Lynch emphasized this in his book, One Up on Wall Street. Chapter 4. The Catalyst Countdown. Catalysts can propel a stock's price upward. Identifying these triggers can give you an edge. This chapter explores how to spot and leverage catalysts to your advantage. Earnings reports are a major catalyst. Companies often see their stock prices move significantly after announcing earnings. If a company consistently beats earnings expectations, it can be a sign of good things to come. Product launches can also be big. When Apple launches a new iPhone, for instance, it often boosts their stock. Look for companies with exciting products in the pipeline. These can be game changers. Mergers and acquisitions, M&A, are another key catalyst. When companies merge or acquire others, it can create value. A report by J.P. Morgan found that M&A activity often leads to increased shareholder value. Regulatory changes can have a huge impact. Changes in laws or regulations can create opportunities. For example, new environmental regulations can benefit companies in the renewable energy sector. Industry shifts can also act as catalysts. The rise of e-commerce has been a huge boost for companies like Amazon. Keep an eye on emerging trends that can transform industries. Patent approvals are crucial for biotech and pharmaceutical companies. A new patent can lead to a significant increase in stock price. According to a study by the National Bureau of Economic Research, companies that receive patents often see a boost in their market value. Partnerships and collaborations can open new doors. When companies partner with others, it can lead to growth and expansion. For example, strategic alliances in the tech industry often lead to innovative products and services. Cost-cutting measures can also be a positive catalyst. Companies that successfully reduce costs can improve their profitability. Look for announcements about restructuring or efficiency improvements. Share buybacks are another important catalyst. When a company buys back its own shares, it can increase the stock's value. It shows that the management believes in the company's future. A study by Goldman Sachs found that buybacks often lead to higher stock prices. Chapter 5. Contrarian Investing Secrets. Contrarian investing is about going against the crowd. When everyone is selling, you're buying, and vice versa. It takes guts, but it can be very rewarding. As Warren Buffett famously said, "Be fearful when others are greedy and greedy when others are fearful." Start by identifying out-of-favor sectors. Sometimes entire industries fall out of favor due to temporary issues. For example, during the 2020 oil price crash, energy stocks were heavily sold off. Those who invested in strong companies like ExxonMobil during the downturn saw significant gains when prices rebounded. Look for stocks with high short interest. When many investors are betting against a stock, it can create opportunities. If the company performs better than expected, a short squeeze can drive the stock price up. This happened with Tesla in 2020, leading to massive gains for investors. Pay attention to market sentiment indicators. The put-call ratio, for example, can give you clues about market expectations. A high put-call ratio indicates bearish sentiment, which can be a contrarian buying signal. Consider stocks that have recently experienced bad news. Negative headlines can drive a stock's price down temporarily. If the company's fundamentals are strong, this can be a great buying opportunity. The key is to look beyond the headlines and understand the real impact of the news. Look for companies with strong insider buying. When insiders are buying shares, it's often a sign that they believe the stock is undervalued. According to a study by the University of Michigan, stocks with significant insider buying tend to outperform the market. Another contrarian strategy is to focus on low P/E stocks. These stocks are often overlooked by the market. A study by Bank of America found that low P/E stocks have historically outperformed high P/E stocks over the long term. Invest in companies with solid balance sheets. Companies with low debt and strong cash flow are better positioned to weather downturns. They can emerge stronger when the market recovers. Look at historical performance. Sometimes, stocks that have underperformed in the past can be great contrarian investments. If the company has strong fundamentals, it might just be a matter of time before the market recognizes its value. Consider global opportunities. Sometimes, entire markets or regions are out of favor. For example, during the European debt crisis, many investors avoided European stocks. Those who invested in strong companies during this time saw significant gains as the region recovered. Chapter 6. The Long-Term Vision Blueprint. Value investing is all about the long game. It's not about quick wins but building wealth over time. This chapter will help you develop a long-term vision for your investments. Start by focusing on the intrinsic value of a company. Intrinsic value is the true worth of a company based on its fundamentals. Warren Buffett once said, "Price is what you pay. Value is what you get." Focus on value, not just price. Look for companies with strong competitive advantages. These are companies with moats that protect them from competitors. According to a study by Morningstar, companies with wide moats tend to outperform those without moats. Invest in businesses you understand. Peter Lynch famously advised, "Invest in what you know." If you understand how a business makes money, you're more likely to make informed investment decisions. Diversify your portfolio. Don't put all your eggs in one basket. Diversification can reduce risk and increase your chances of long-term success. A study by Vanguard found that diversified portfolios tend to perform better over time. Be patient. Value investing is not about timing the market but about time in the market. Legendary investor Benjamin Graham said, "The market is a voting machine in the short term and a weighing machine in the long term. Focus on long-term trends and ignore short-term noise." Reinvest your dividends. Reinvesting dividends can significantly increase your returns over time. According to a study by Hartford Funds, reinvested dividends accounted for 82% of the S&P 500's total return from 1960 to 2020. Stay disciplined. Develop a clear investment strategy and stick to it. Avoid the temptation to chase hot stocks or market trends. John Templeton, a pioneer in value investing, once said, The four most expensive words in the English language are, this time it's different. Stick to your plan. Keep an eye on valuation metrics. Regularly review key metrics like P/E ratio, price-to-book ratio, and dividend yield. These metrics can help you determine if a stock is undervalued or overvalued.